Perhaps stating the obvious, if one sells an asset at a profit, then it will usually trigger a capital gains tax liability. That said, some assets are not chargeable assets at all, and they can be disposed of without any tax charge. Additionally, the sale of some assets will also qualify for various capital gains tax reliefs made available by the government, generally to encourage certain types of behaviour. These reliefs may exempt a gain either in full or part, or alternatively some will act to defer a gain until a later event may trigger the liability. So for example, over the last few decades, there have been tax reliefs providing for a low rate of capital gains tax where entrepreneurs sell their businesses. Regardless of whether you feel this is the right thing or the wrong thing, it is clearly ingrained policy of successive governments that an entrepreneur should pay less tax in these circumstances, rather than, say, someone who sells a Picasso painting that's been hung on their wall for a couple of years. Perhaps the most commonly encountered CGT relief will be main residence or principal private residence relief, which exempts all or part of the gain on one's home on sale, depending on how long you've occupied that property. It's perhaps fair to say that CGT is often more of a concern for high net worth individuals on the basis that they are perhaps more likely to hold assets which have appreciated in value. Our view is that it's important for this type of client to consider what reliefs, if any, are available to reduce the taxable gain. I must stress the importance that any consideration takes place before the asset is sold. As you would expect, we have experience in advising on a variety of CGT cases. So for example, we recently advised a business owner who was disposing of shares in his personal trading company. This company held a number of high value investments in unconnected companies, and we advised on necessary steps to take to ensure that he locked in entrepreneurs relief, which resulted in a 10% tax liability rather than 20%. So essentially the device halved his liability on sale. Recently we've also advised many buy-to-let landlords on how to reduce their capital gains tax liabilities on the disposal of properties. This has been of particular interest in the last year or two, given the increasing tax burdens being placed on buy-to-let landlords. We've also advised clients on the tax benefits of making certain investments, known as EIS or CDIS, to reduce their liabilities. These reliefs reduce taxable gains based on the value of proceeds reinvested in companies which are generally small trading companies. The government introduced this relief to incentivise taxpayers to invest in growth companies. So further, an individual's tax status, whether he is resident or domicile in the UK, will also have a significant impact on the tax position as and when they sell an asset. So this, in turn, does provide other planning opportunities as well. So if you have any queries about CGT or are considering the disposal of a capital asset, then please get in touch.